Are the bond market's big glory days behind it? Bill Irving is a fixed income portfolio manager at Fidelity. Mr. Irving, welcome. Where do you stand on the sort of fracture there between UBS on the one hand, saying the worry is overdone, and Goldman on the other saying this time it's for real, the bond bull may be on its last legs?
Well, certainly the backup in yields this past month has been sharper and more sudden than I think many market participants expected. But in my opinion, the backup so far has been both healthy and reasonable. And what I mean by that, if you go back to the beginning of May, on the one hand, the yield on a 10-year Treasury was only 20 basis points above its all-time low. It was around 1.6%. Meanwhile, at the same time, the recovery continues to take hold. We had a very strong employment report this past month. Household balance sheets are improving. The fiscal outlook in the United States is improving. All good. So those two things were inconsistent. And then more recently, you have had the Fed rhetoric, which has made clear to the market that the quantitative easing program is not going to last forever, and they're going to begin tapering their purchases either in September or I would say by December of this year. So for those two reasons, I think, contributed to the sell-off we've seen in the bond market.
All right, but Bill, should you, this is Susie, should you, if you're an investor and you've been holding bonds, should you keep holding on to them or should you sell? I mean, a lot of people really believe that it's safer to keep your money in those bond funds. But can you make money with Treasury yields at 2% and inflation around 2%?
I think that yields will continue to rise throughout this year as the recovery continues to normalize. But I don't think it's going to be a straight path to higher yields, and I don't think it's going to happen as sharply as what we've seen this past month. I think that we're in a more volatile environment where interest rates are going to be more sensitive to the economic data. So, for instance, if next Friday we get a payroll report where we've added 250,000 jobs, I think it is possible, the 10-year yield could rise, say, 20 basis points. But on the other hand, if we get a disappointing number, I think we could go right back to 1.8% on the 10-year yield.
There's really been almost a 30-year bull market in bonds, Bill. I don't have to tell you that, but certainly over the past 10 years, an awful lot of people have made a tremendous amount of capital gains in their bonds and bond fund holdings. Do you think that era is over and that people ought to reset their expectations in terms of the returns they might derive from their bond funds?
Absolutely. That is, I think, the most important point. A starting point to estimate what returns might be going forward. The yield on the aggregate, the Barclays aggregate, which is a broad investment grade bond index, is around 2%. So if yields stay just where they are, then over the next year you can expect about a 2% return. And if yields rise, then that's going to eat into that return. And so they could be lower, they could even be negative. So I think the most important point is the strong returns that bond investors have enjoyed over the past several years, 5, 6, 7, 8% returns, they need to reset their expectations significantly lower.
All right, Bill, we have to leave it there. Thank you very much. Bill Irving of Fidelity tonight.